For decades, financial advisors have all told you the same thing. As retirement approaches, shift your money out of stocks and into bonds. Play it safe and protect what you have. But what if that conventional wisdom was wrong? What if the research actually supports staying 100% in stocks across your entire retirement, and you can actually spend more money while doing it? I'm Terrell Higgins, and in a world filled with information, what you're really looking for is transformation. And today, I'm going to show you why everything you think you know about retirement portfolios might be backwards. We're going to dive into what the real risks for your retirement portfolio are, why conventional solutions fall short, and why an all-stock portfolio could lead to you having more money and a better retirement. Let's get into it. Before we talk about solutions, we need to understand the enemy. Every retirement strategy is combating the same villain: sequence of returns risk. So here's what that means in plain English. Let's imagine that you have a $1 million retirement portfolio. And we're going to zoom in to the first 5 years of that retirement. So for the first 3 years of that, you get 10% every year. And then the next 2 years, you lose 10% each year. If you're not taking any withdrawals, that order doesn't matter. You're going to end up in the same place. But if you're withdrawing money each year, that order becomes everything. If those bad years hit early, you're actually pulling cash from a shrinking account. This leaves less money available to recover when the market bounces back. So you've locked in those losses at those market lows. But if the good years hit early, then your portfolio grows before the downturn happens. This provides a bigger cushion when things go south. This is sequence of return risks. Withdrawals combined with early market losses can devastate how long your money actually lasts in retirement. This is the risk that we're trying to manage with our retirement strategies. And this is going to be the basis of everything that we discussed today. So how have advisors traditionally dealt with this sequence of returns risks? There are two main approaches. The first one is the bucket strategy. You take your money and you divide it into 3 buckets. The first bucket is a cash bucket for years 1 to 3. The second bucket is bonds and is for years 3 to 10. And then the third bucket is stocks for years 10 plus. The logic here is if losses hit early in your retirement, you're spending from those conservative buckets of cash and bonds. So you're never forced to sell your stocks at those lows. It gives your stocks time to recover and grow when you need them later in retirement. The second strategy is the glide path strategy. And this is where you gradually transition from stocks to bonds over time. You start aggressive, and then you get more conservative as you age. And recently, some researchers and advisors like Michael Kitces and Wade Pfau have modified this strategy. So they start you at a 30% stock allocation, and then they slowly ramp you back up to a 60 to 70% stock allocation as you age. The logic here is that after you get past that early sequence of returns risk in retirement, you can get into a more stock-heavy portfolio for growth. But both the bucket strategy and the glide path strategy share the same playbook. Use bonds to cushion early losses in retirement. Sounds smart, right? But here's the problem. Bonds are like training wheels. Great for stability, but terrible for speed. In 2008, when the market crashed 37%, Treasury bonds actually rose 20%. That cushion saved people's retirement portfolios. But from 1928 to 2024, stocks have actually averaged 11.8% annually, while 10-year Treasury bonds have only averaged 4.8% annually. That 7% difference in performance compounds to something massive over a 30-year time horizon. And worse yet, if inflation is going up 3% and your bond portfolio is only making 4%, it's eroding your real purchasing power silently year after year. So bonds protect you from short-term volatility risk, but they're actually exposing you to long-term inflation risk and potential portfolio depletion. So we've got a dilemma. Stocks are volatile early in your retirement when you're most at risk, but bonds are too conservative and can't sustain you long-term. But what if there's a third option here? So researchers have tested something that sounds extreme: staying 100% in stocks across your retirement. But with a crucial twist: flexible withdrawals. So if the market crashes, you tighten your belt and you spend less money temporarily. And if the market soars, you can spend more freely. Here's how the three strategies stack up based on historical backtesting across 30-year retirement timeframes. They backtested these three strategies across the worst possible conditions: the Great Depression, 1970 stagflation, the dot-com bubble, the 2008 global financial crisis. And if you look at these results, you notice something. The 100% stock strategy has slightly lower success rates, but the median scenario leaves you with about $700,000 more than the other two strategies. Why? Because you're capturing the full upside of equity returns. You're not handicapping your portfolio with bond returns for decades. But there's a catch. You have to be willing to cut your spending if the market goes down. And if it's a bear market, you might have to cut your spending for several years in a row. This is where theory meets reality. You can't just wing it based on emotions. You have to set up guardrails around your spending. And there's a lot of different methods for flexing your spending and setting up these guardrails, but I'm going to cover the two most popular methods. So the first one is risk-based guardrails. And this is how the professionals do it. They set up thresholds based on your portfolio value and your retirement success probabilities. So if your portfolio value falls below a certain floor, you're going to have to reduce your spending down. And if your portfolio value goes above a ceiling, then you can increase your spending. Advisors can help you set this up, or you can use software tools like Bolden to figure out what your portfolio ceiling and floor should be. The pro is that this is data-driven, it's precise, and it optimizes for the outcome. The con is that it's a bit of a black box and it requires professional tools or an advisor. So the second way is Guyton-Klinger guardrails. And this is DIY friendly and super simple. So you figure out the 5% withdrawal rate, what that would be in cash, and you keep withdrawing at that set amount. And then if your account balance goes down, where that set amount in cash turns into a 6% withdrawal rate, you're going to have to adjust your spending down 10% to get back to a 5% withdrawal rate. And then if your account balance goes up so that that set amount of cash turns into a 4% withdrawal rate, you can actually adjust your spending up 10% to get back to a 5% withdrawal rate. Super simple rules. You can do it yourself with a calculator, but it's going to require a lot more discipline, and you're going to have to make more frequent adjustments. Both risk-based guardrails and Guyton-Klinger guardrails accomplish the same thing. They force you to reduce your spending in bad markets systematically and not emotionally. They prevent you from depleting your portfolio in those critical early years of retirement. But here's what the numbers don't tell you. You are not a spreadsheet. Research shows that retirees with a fixed withdrawal strategy, like the famous 4% rule, actually end up underspending out of fear in retirement. They end up dying with millions of dollars unspent and sacrifice quality of life in retirement. Flexible withdrawal strategies can actually give you more confidence to spend in retirement because the rules are clear. If the market goes down, you spend less, and if the market's going up, you can spend more. No guesswork, no panic. But, and this is critical, 100% equity strategies require financial literacy and emotional fortitude. If you're going to lose sleep over volatility, then the optimal strategy is completely worthless. Glide path and bucket strategies, they're easier to understand and feel safer, even if they're actually going to leave less money on the table in retirement. The best strategy for you is not necessarily the one with the best expected return. It's the strategy that you can actually stick with across your retirement. So let's bring this all home. Sequence of returns risk is the real enemy in retirement, but so is inflation. Bonds protect against short-term volatility, but they actually introduce a long-term inflation risk and longevity risk for your portfolio. Equity-heavy portfolios, all the way up to 100% equities, when they're paired with a flexible withdrawal strategy, can lead to significantly higher portfolio balances across your retirement. And the key to selecting the right portfolio and withdrawal strategy for you is dependent on your personality and your financial situation. The mathematically optimized portfolio is completely worthless if it causes anxiety and leads to you abandoning that plan. And if today's video completely reshaped how you think about retirement portfolios and retirement withdrawals, like the video, subscribe to the channel, and share this video with somebody else who's planning for their future. Keep getting 1% better every day, and I'll catch you in the next video.